Hello and welcome back to the Microlearning Institute. In this tutorial we look at the topic of IFRS 2 share-based payments, and specifically we look at an example of how to address a grant with a performance condition in which the length of the vesting period varies. Now, you will remember from previous studies that for equity-settled share-based payments, the value of the cumulative equity that appears on the statement of financial position at year-end is calculated from the formula the estimated number of employees entitled to the grant multiplied by the number of instruments per employee multiplied by the fair value of each instrument at grant date, and that is time apportioned over the vesting period, and a corresponding movement goes to the P&L. In this example, we're told that at the beginning of year 1, an entity grants 100 shares each to 500 employees, conditional upon the employees remaining in the entity's employ during the vesting period. The shares will vest at the end of year 1 if the entity's earnings increase by more than 18%, at the end of year 2 if the entity's earnings increase by more than an average of 13% per year over the 2-year period, and at the end of year 3 if the entity's earnings increase by more than an average of 10% per year over the 3-year period. The shares have a fair value of $30 per share at the start of year 1, which equals the share price at grant date. So here we have a summary of the vesting criteria. Year 1, 18%. After 2 years, 13% per annum, or that's a cumulative of 26%. Or after 3 years, 10% per annum, or a cumulative of 30%. Now we're told that by the end of year 1, the entity's earnings have increased by 14% and 30 employees have left. The entity expects that earnings will continue to increase at a similar rate in year 2 and therefore expects that the shares will vest at the end of year 2. The entity expects, on the basis of a weighted average probability, that a further 30 employees will leave during year 2 and therefore expects that 440 employees will vest in 100 shares each at the end of year 2. So now here we look at the actual target percentage and the actual, so we can see our actual performance was increased by 14%, and if we continue to increase at the same rate next year, that's an additional 14%, that will be a cumulative of 28%, which is greater than the 26% target needed for vesting over 2 years. So now let's look at how we will account for this to the statement of financial position and to the P&L. So we apply our formula, so 500 employees, 30 have already left, and we anticipate that a further 30 will leave between now and the end of the vesting period. They each get 100 instruments whose fair value at grant date was $30, and we time apportion the equity over the expected vesting period, which we now expect to be 2 years. So consequently, the cumulative equity that we recognize is 660k, and we recognize a corresponding entry to the P&L. Next, we are told that by the end of year 2, the entity's earnings have increased by only 10%, and therefore the shares do not vest at the end of year 2. We're told that 28 employees have left during the year, and the entity expects that a further 25 employees will leave during year 3, and that the entity's earnings will increase by at least 6%, thereby achieving the average of 10% per year. So now we can see our actual performance at the end of year 2 having increased by 10%, so that's a cumulative of 14% plus 10%, which is 24%. So we haven't met the criteria of 26% that would enable us to vest these options at the end of 2 years. However, we are expecting that our earnings will increase by at least 6% in year 3, so that would mean that we would at least hit the 30% target at the end of year 3. Let's look now to see how at the end of year 2 we account for the cumulative equity, and here we see that of the 500 employees that started, 30 left in year 1, an additional 28 left in year 2, and we anticipate that 25 will leave in year 3. Again, they're each entitled to 100 instruments. The fair value at grant date is still $30, and now we time apportion it over 2 years out of the expected 3-year vesting period. So this now gives us a cumulative equity at year-end year 2 to be recognised on the statement of financial position of 834k. So at the end of year 1, that cumulative equity was 660k, so the difference of 174k is the expense we need to recognise to our P&L in relation to this share-based payment in year 2. Next, we're told that by the end of year 3, 23 employees have left and the entity's earnings had increased by 8%, resulting in an average increase of 10.67% per year. Therefore, 419 employees received 100 shares at the end of year 3. So let's have a look now. We can see that our actual performance is 14% in year 1, plus 10% in year 2, plus 8%. So our cumulative improvement has been 32%. So we have exceeded the target of 30% that allowed the shares to be vested at year-end year 3. And now let's look at the cumulative equity to be recognized at year-end year 3. So we had initially 500 employees. In year 1, 30 left. In year 2, 28 left. And now 23 have actually left at year-end year 3. Each again are entitled to 100 instruments. $30 at grant date is the fair value at grant date, and we now recognize the cumulative equity because this is the end of the vesting period. So our cumulative equity to the statement of financial position is 1257k. Again, that's an increase from the 834k the previous year, so we recognize a corresponding expense to the P&L of the difference between 1257k and 834k. That's 423k. Thank you very much for watching this short tutorial from the Microlearning Institute.